प्रभु जी ऐसी धूम मचायो सकल जगत को उसने बचायो उसकी महिमा करो मैं अपरंपार बार बार उसकी महिमा करो मैं.
So let's come to today's topic, which is part of that foundation that I talked about of insurance and emergency funds. And the topic, the first thing that we're going to talk about is life insurance. Now, much of life insurance basics you know in one form or other, but I'll just go through it just to clarify things a bit and to maybe answer some questions or add some insights to it. First of all, life insurance, like any other insurance, is nothing more than a transfer of a risk. Okay? A risk that you cannot bear yourself because it's too big. Okay? And even people who can bear the risk because they have the wherewithal, they have the resources, still take insurance because it's cheaper for them to let the insurance company bear the risk than to deplete their resources. Okay, so let me give you some examples before we come down. Let's talk about examples that you can relate to before we talk about life insurance. Let's talk about auto insurance. Okay, when you buy an automobile, there are two risks that you cannot bear yourself. Okay? You may or may not. If I go out there and buy a vehicle for $25,000 brand new, and I drive it off the parking lot, and because in my excitement, because it's a new vehicle and whatnot, and I hit a tree, right? If it's not insured, I'm out $25,000, right? But if I transfer the risk to an insurance company, in most, you may or may not be aware of this, but if you have an existing policy, and you go out and buy a vehicle without even telling your insurer, that vehicle is covered. It's called a newly acquired vehicle. For 21 days, it's automatically covered on the same basis as your other vehicle, right? Just so that you know. But most people, before they go out and get a new vehicle, they would call up their insurer, get it insured, give all the details. Now, let's say in that situation, okay, I omitted to do that, and I hit a tree. I'm out $25,000. If I have $25,000, it's depleted my resources. But if I don't have $25,000, I have a bigger problem. Right? Whereas for $1,000, $2,000, I transfer that risk to an insurance company. Now they bear the risk, right? So it's a transfer of risk. So in life insurance, what is the risk that we are transferring? What is the risk that we're transferring? It's the risk of running out of time. Okay? Now the Lord says that, the Bible says that the average person lives 70 years. But people die younger. People die older. No one knows when they're going to die. And so there's always that risk that, look, I may not make it home tonight. Responsible as I am, I may be careful, put on my seat belt, don't drink and drive, but we'll live in a world that has got evil in it. Okay? And there are people who do not do all those things. And we live in this world. So there's the risk that I may run out of time, may not make it home tonight. And if I do not make it home tonight, there's the risk that, I will, the repercussions of that is a loss of income. The employers that you have, whatever your source of income is, whether you are employed or self-employed, as soon as you stop dancing, the music stops, right? Your employer, they'll do whatever they need to do, if you pass on. And beyond that, they'll just go out there and find, they are mandated to find your replacement and keep things going. And, you are on your own. The paycheck stops at some point, right, without insurance. It's compounded by other things. Not only does the paycheck stops, there might be debts that are there. And, many of us carry debt, mortgage, a car loan, student loan, credit card balances. And without insurance, who's going to pay for those, right? And if you are in a single situation where, you have no dependents or whatsoever, there's still the issue of last expenses. I don't know if you've ever inquired about, were involved in last expense. I'm talking about funeral costs. It's pretty expensive. It's not cheap, I know a gentleman who died a couple of years ago, and I was told the story that he didn't have any money. So, they passed the hat around to buy him, not to buy him, to cremate him, because there was just no funds there to take care of him. So, there are last expenses, there are debts, there's a loss of income, and those are the repercussions of running out of time. All right? So how do we address that? We address that through life insurance. And what we do is it's called life insurance, but it's really a misnomer. I really think that it's more of time, and what you're buying is time. Okay? You're saying that if I run out of time, okay, what I could have earned, what I could have done had I had the time, we quantify it, and we buy insurance on that basis. All right? So the amount, how much of life insurance you should need can be quantified in one of three ways. One is on the basis of your income. So if you are, let's say, 30 years old, and you figure I'm going to be, I'm going to work till I'm 65, another 35 years, and if you make, I don't know, $40,000 a year, all you do is you take 30,000 multiplied by 40,000 by 35 years. In absolute numbers, you might want to add in an inflationary factor in there, and that's how you come up with a number. Right? That's one way to do it. Another way to do it is to look at your needs. Sit down and see what would happen. If I were to die, my kids, let's say, under 5 years old, they're going to be dependent on me for another 20 years. And I've got a mortgage, and I've got these debts. Whatever the specific needs are, you quantify them and come up with a number. Okay? It's not an exact science. Okay? Even if you did it via income and via needs, periodically, it's a constantly changing picture that you really have to readdress it, revisit it over time. Now, those are two ways to do it. What I prefer to do is what I call financial milestones. Okay? And there are two milestones at the end of the day that I'm trying to take you to. And one of them is having an investment portfolio of $1 million and more. Okay? Now, depending on where you are at financially, it might seem like very far and very unreachable. But if you do what I suggest you do, it's not inconceivable. Okay? You can get there. And the idea is, look, if that is the goal that I have set, if the first financial milestone of 1 million plus, then if I run out of time, I want this to be self-completing. Okay? And in the process, I've taken care of a lot of, to me, to do it via income and via need, and then to constantly readjust it along the way. Okay? I'd rather do it the other way. And when we get into the numbers in life insurance, you will understand why. Because life insurance increasingly costs more as you get older. And not only does it cost more, accessibility becomes an issue too. Because the insurance companies won't touch you with a 10-foot pole if you have certain conditions, right? And those of us who are past 30, we know that nature takes care of you right up to age 30. Then after age 30, it doesn't care about you, and it wants all its parts back, and quickly. And so while you have your health, right, and I'm saying, I prefer to do it via milestones. This is where we're headed, okay? And let's get this in place, so that if I run out of time, run out of health, this is self-completing. But if I am there, and if I do what I'm supposed to be doing, if I put the blinders on and follow the steps, right, I will get there. Matter of time, everybody will be different, depending on one's income, depending on where you're at. All right? Now, the types of insurance that are out there, there are only three kinds. One is called term insurance, and this is a website that you might want to take note of. It's called termforsale.com.ca. It lists both Canadian and American. I'll go there and we'll take a look at it. Both Canadian and American rates for term insurance. Now, term insurance is what, as its name suggests, it's term insurance. It stands for temporary, it's a short form for temporary insurance, okay? It could be for 5 years, it could be for 10 years, it could be for 30 years, it could be for a lifetime, 100. Now, the most popular that are out there when people talk of term insurance is 10-year term insurance or 20-year term insurance. When I counsel people, when we sit down and we, agree on the need for insurance, and if the cash flow is an issue, if they don't have the immediate cash flow but the need is there, this is what we typically take, okay? A 10-year or 20-year term insurance just to buy us some time until we free up the cash flow through elimination of debt and by becoming tax efficient or by earning more. So here's, if you go to this website, termforsale.ca, a very simple website. You've only got a few steps to do, and it'll do some comparison shopping for you. So the first thing you need to do is put in the 3 letters of your postal code, and then put in a date here. So I'm going to take somebody who's in his, let's say, 40s, I guess. Yeah, okay. Let's start with somebody in their 40s, and let's do $1 million, and let's go with a term, 100-year term. Right. And you hit compare, and voila, you get this. And it comes up with the rates of the top 20, 25 companies. Okay. As you can see, Manulife out there, the premium for $1 million is $8,443, and decreasing as you go along. There's a company, the Union Life Canada, that's charging for the same thing $16,000, double.
I don't quite understand what is term 100. What
Okay.
does that actually mean?
Okay, term to 100 means that the rate is fixed from the time you come in till age 100, at which time the policy is paid up. Okay, now we're going to just come back in a second to talk about the other kinds of insurance. Now, term insurance means it's like it's pure insurance, right? It's like your car insurance and your home insurance. There's no savings element attached to it. It's a pure term. Now, when you have a 10-year term, what it means is this, that if you come in at age 40, they're going to charge you a flat rate for the next 10 years. But at the end of 10 years, you're going to be 50, right? You have a new set of rates, so it's a step up. New set of rates for the next 10 years till you're 60. And when you're 60, another 10 years till you're 70. And with most companies between ages 75 to 85, they do not renew it. So, we'll talk about the differences in a second, and that's one of. So, term insurance is pure insurance, no savings element attached, and depending on the length of term, the rate is fixed for that period, and it's renewable, usually up to age 70 to 85. Okay, and then they will not renew it. So, the most popular out there right now are 10-year terms and 20-year terms. So, if you come in at age 40 and you took a 10-year term, your rate is fixed for till you're age 50, at which time it goes up, and it's guaranteed at issue. So when you get your policy, it'll tell you what your rates are going to be at 50 to 60, 60 to 70, and 70 to 75, let's say, at which time it doesn't renew. So it buys you insurance for the next, at least you know what you're in for, right? And if you took a 20-year term, then the rates are fixed for 20 years. And of course, 20-year term insurance would cost more than a 10-year term. And a term to 100, which is what I recommend, because everything that I do is based on solid planning. Okay, we don't want to come in and have to readdress this down the line and find that we're not able to get this, or it's going to cost more, and it just throws off. I don't want to move backwards. I want to move forward, right? So the other one that's out there is called the term to 100, where you come in at age 40, and they're saying that, look, we're charging you so much, like this company, for instance, for $1 million, $8,443, the cheapest one there. Manulife says that for $8,443 a year, we will insure you up to $1 million till you age 100. Now, this person was 41, right? We said, yeah. 40. This person is in his 40s, 39, yeah. Right? So, till age 100, the rate does not change. right? Now, when we come in the latter part of this, I'm going to talk about life insurance strategies, and I'm going to show you why, how to do this, how to pick between term and permanent insurance. Does that answer your question, Peter? Okay. So the opposite of term insurance is what's called permanent insurance, right? And which is what we're going to come into. So, that website that I gave you, it's a good website to go to if ever you are in the market for term insurance, to get term insurance. Now, as opposed to term insurance, the other two insurances, the other two main kinds of insurances that are out there, one of them is called whole life, and the other one is called universal life. Now, universal life did not come about until the early 80s. Prior to 1980, there was only two kinds of insurance. Okay, and when you read or you hear about insurance, life insurance particularly, people talk about these: term insurance or whole life insurance. And the whole life insurance is the one that has got a savings element attached to it. Okay, and prior to the high interest inflationary environment of the early 1980s, there was only these two kinds of insurance. So either it was term insurance or it was permanent insurance. And there was a lot of the whole life policies were not were very rigid, okay, in the sense that they were about 4 to 6 times more expensive than the permanent insurance, and you didn't have a lot of control in how the money was invested. You were given fixed rates. However, having said that, okay, people who did invest in those have come out better in the long run. Okay, when in that environment prior to the 80s, when you had just term insurance and whole life insurance, there was a concept that was out there that said it is not smart to buy whole life. It is better to buy term insurance and to go and invest the difference yourself. And that makes a lot of sense, because if you look at the numbers, and if something was going to cost $100 versus 4 times $400, why not take the $300 and invest it yourself versus letting the insurance company invest it for you? It is right. You could do better with your money, but then it is you who's taking the risk. Okay? The problems that we have found with that is that in theory it works. There's a human factor here. People do not invest the difference. And at the end of the day, they neither have this nor that. They've got this cheap term insurance, which is costing them increasingly more and more money, and eventually they cannot keep up with it, and then they have to let it go. So they no longer have the insurance, and they don't have the investments. Whereas the person who was more conservative, who went the other route and said, I'll go with the whole life, in the long run, they have come up better, because through, and some, depending on the kind of whole life, there's one called the participating whole life. In some of these policies, net of expenses and everything, they have returned about 6 to 8%. And over a 40, 50-year period, comparatively, that's pretty good. Okay? Because it's very hard to do the same elsewhere. Now, in the early 80s, what happened was, because of the high interest rate and inflationary environment, a lot of people who had whole life policies, okay, and you have certain privileges in a whole life policy because you're paying about 4 to 6 times more for the same thing, right? And one of them is what's called the cash value and loan privileges. So in the early 80s, what happened was, because interest rates were very, very high, and because there were privileges built into these policies where you could borrow money at a fixed rate of 6%, accountants and people with financial savvy were taking monies out of these whole life policies and reinvesting it outside in the high interest rates. At that time, they were running anywhere from 16, 17, 18%. So it made a lot of sense. If you have a whole life policy where you can borrow on that policy on your cash value, at 6%, borrow at 6%, and to go and invest it outside at 18%. And as a result of that, there was a big cash outflow from insurance companies through these policies. And to address that, the insurance industry came up with the universal life policy. And what the universal life policy does is it makes it unnecessary to do that. Because what it does is it says, we have a policy, and we make it as very flexible and very transparent. You design it the way you want it to. There's a minimum premium, and there's a maximum premium. If you only pay the minimum premium, it works like term insurance. All you get is pure insurance, right? But if you put in the maximum premium, it works like a whole life policy. You've got a savings element in there. And you get to choose where that difference is invested within the policy, right? So this is how universal life came about. And then people started becoming creative with that. They didn't see this as insurance anymore. They saw that corridor between the minimum and the maximum as a tax shelter, ways to shelter money. And this is what's happened. So that's the evolution of it. When I sit down with people and we do insurance, it's usually universal life, okay, because it's much more flexible. Depending on the cash flow situation of the family that I'm dealing with and depending on their needs, we either structure it as term insurance, but we have the flexibility over time as cash flow improves and as things improve to do a lot of other things. And one of the things that we'll be looking at further down the line is estate planning. And in estate planning, this is a very, very important tool. Okay, when I meet people in their later stages of life, it is unfortunate that I didn't meet them earlier because it's costing us so much more to address their estate planning needs because they do not have sufficient life insurance. And we need, when we sit down and look at the liabilities that are going to be created by death, right? Even at the more exorbitant cost, it still works out cheaper to get the insurance than not to get it. Then the issue usually becomes getting it, okay, because of their deteriorating health situation. It's a challenge just to be able to get the insurance. So those are the basics of life insurance. Is there any question? Is there something that you are not clear about, or does it give you a better sense of what life insurance is? Anybody?
Personal accident is something different.
We are trying to make sure that it gets recorded. No questions.
So where does personal accidents come in if they are actually in there?
You can hold on there. Personal accidents. What do you mean? What do you mean by personal accidents?
I think there are some insurance where it's very cheap, where you buy just for personal accidents.
Okay. Accidental policies. In those policies that you're referring to are called accident policies, where death has to occur by a violent external force, because it's very restrictive. It becomes very tricky, because if you die of a heart attack, then they won't pay. Okay? In many of these policies, both term policies, whole life policies, and universal life policies, you can put in a rider, they call it, a clause in there that's called accidental death payment, whereby if I'm insured for $100,000, but if death is accidental, meaning that the cause was external and violent, as opposed to anything other than that, okay, they pay double. It's called double indemnity or triple indemnity. You see this in travel policies when you buy travel policies. Double, triple. So depending on so what you're referring to is an accident policy, where death has to be caused specifically by an accident, and by accident they mean something external and violent. Okay? Because it's restrictive, it's very hard to base your security on that. You follow what I'm saying? So we want a policy that says it pays as long as you are not alive. Okay? Now most life insurance policies, the only restrictions that are there usually, one is suicide. In fact, it's across the board. when you buy a life insurance policy, there's usually a clause in there that says that if you commit suicide in the first 2 years, they will not pay. Okay? It's just built into one of the conditions that are there, because they don't want people adverse action, right? You know, people think they have a lot of financial problems that, you know, I actually have one client who actually thought that you know, he could solve his family's problems by committing suicide. He contemplated that because there was money there. He says, I'm better dead than alive, because I can't provide for them while I'm alive. At least if I die, this money will go to them, you know. And the insurance companies are aware of that, and so to prevent that, they put that clause in. So accidental policies are policies that only pay in the event of an accident. Okay. Any other questions? So these are basics. Now, one of the things that you should be aware of also is group insurance, right? Many of us are employed either through employers or through our associations. We get group insurance. And in those group insurance policies, the life insurance that you get there, and Peter, coming back to your question, in a group insurance policy, the life insurance that you get is a 1-year term insurance. 1-year term. So the group, for instance, POAC, negotiates with a carrier for all of its members, right? At the end of 1 year, just like your auto insurance and your home insurance, the carrier sends a renewal to POAC or to your employer. And your employer looks at it, either they accept it or they reject it or they go to another carrier. But it's a 1-year term insurance. Okay? So one of the slogans that I have out there is that most people that I meet are either uninsured, they're underinsured, or they're only group insured, okay? And that's a danger in doing that. And especially in our environment where, you know, used to be, there was a time when, you know, you could be at a workplace for the rest of your life. You know, it was permanent employment. When those times are gone, the average stay at a job these days is about 2.5 years, okay? It's you know, the statistics say that, you know, we'll work for 7 employers during our lifetimes. And because of that, it is, you know, it's a mistake to depend solely on group insurance. When I sit down and, you know, when we're doing financial planning with families, the group insurance is acknowledged, okay? But we do not base, you know, our planning on that. It's there, we accept it, because one day to the next, it could be gone. You leave your employer, it's gone. Although you have the privilege of converting it, but you won't be doing it at a time when you've already lost income. Right? Does that clarify things a bit for you? Does that, you know, give you a better sense of what life insurance is?
Would group insurance cover step 2 as a minimal insurance for life if you had nothing else?
Absolutely, absolutely. You know, what I say in step number 2 is, let's not, you know, ignore the problem. There's a danger that I may not make it home tonight. There's a danger that, you know, if I'm not feeling well, the doctor might give me a death sentence by saying, look, you've got cancer, you've got 2 weeks. And we've all gone through this. We've lived it, right? You know, across the board. And the statistics are so high. Every day I turn on the TV, every day I read something. I mean, it's just, the other day I was watching Dr. Oz with Suzanne, and the guy was saying that 1 in 4 people are prone to be diabetics or pre-diabetic. 1 in 4. That's a high number. I mean, what are we waiting for? The shoe to drop before, you know, we address it? You understand? So I'm not into this, you know, there's, you know, there's so many things that need to be done. My angle is always the financial, right? Because those come with, you know, financial implications, right? So yes, absolutely. You know, while we have it, we'll take it, for sure. And depending on the family's cash flow situation, we'll find the cheapest possible. And like I said, we're going to look at numbers in a second when we talk strategy here, that it is not expensive, okay? 2 years ago, I started a project called Trillion for Christ, okay? And the idea was to get the Christian community to buy policies and name their churches as beneficiaries. And at age 30, for a $10,000 policy, it started at like $30 a year. And yet people didn't sign up because they don't understand it. If they did, it's nothing. It's nothing to you to come up with $30, $60 a year. You write 1 check annually. But if something happens to you, aside from a check goes to your church or to your ministry. But people never grasp that concept. And it's still out there. You know, we'll come back to it and revive it in a different form. But
So, Marty, can I buy several? Can I buy one of those and have other life insurance, or will they only sell you one?
no, you can have as much as you want. But every time an insurance company, every time you apply for insurance, the amount of insurance that you have comes into play. Because one of the questions they will always ask you on a life insurance, what other policies do you have? And this is to prevent adverse action, okay? Because if I'm making $50,000 a year, and if I have just bought, if I go out there buying insurances, the underwriter, and this is his or her job, is to question it. Why are you buying so much? You know, like what, you know, it's not congruent with what you need. And it's not consistent. So there's something wrong there, something wrong with the picture. So it comes into play as long as it's not out of whack. It makes sense. There's no reason.
So let's say I have group insurance, I've got travel insurance, I've got diving insurance, and I've got a policy and I die. They all pay out, that they can never claim that someone else has already covered it.
It's not integrated.
They can't work and win their way out of it at all.
No. The next session that we'll be doing is called disability insurance. And when we do disability insurance, you'll see that disability payments are integrated. They don't care how many policies you have, but there are laws out there in place that you can never collect more than 60 to 70% of your previous income.
Okay, so it's disability only though.
Yeah, integrated.
You also said there was a maximum insurance we can get for life insurance.
Yes, the maximum, because most life insurance companies out there, and we've got over about 200 companies in Canada, right? Each one of them has a capacity to write about $2 million on their own, okay? Now, I've written a policy of up to $6 million on one individual, okay? Now, for different reasons, and every time we do that, we have to justify, why are we doing this? And we usually do this for tax planning reasons. We're just being creative, right? There's no need for insurance to support someone, or someone is not dependent on those monies. We're doing it for different reasons, and when you do that, it's a longer process. And the reason why it's a longer process is because the front company is not the only one who's carrying that risk. They have to go to what's called reinsurers, okay, insurers, and spread the risk. And so now they have to justify it to them. So it's a longer process, but it can be done. We can insure anything. We just have to justify it. And if you cannot justify it, then it won't be done. Now, justify it, what they call financial underwriting. There's always the medical underwriting that's very difficult to get past to. You follow? That's,
Yeah, I guess I'm still not understanding that. Like, my understanding is that there's some rule that says, for example, my understanding is that there's a rule, for example, that says I can only be insured up to, let's say hypothetically, $1 million. And I cannot purchase another policy so that I'm insured for $1,001 because there's some rule that says you've hit the roof. So you're saying it's infinite possibilities for how much I can be insured.
I'm saying that there is no upper ceiling. Okay, there's no ceiling as such, right? But every insurer, nobody can go out there and get as much insurance as they want, because at some point they will turn you down because it cannot be justified. The only person who's got the one who's got the most insurance on the planet right now is Bill Gates. He's got $20 billion of insurance, and it was a nightmare getting it for him. Okay, because of Bill Gates is number 2 richest in the world, number 1 at various times, right? I mean, the wealth that he has, he's worth about $50 billion, and he's the only one who's insured for $20 billion. It was a nightmare getting that policy because of the way it had to be done. So the answer to your question is no, there is no limit as such. Okay, but having said that, you cannot go out there and get as much as you want, because when you do go and you've got a policy of $1 million, and you decide on a whim that I want to get another $1 million. When you apply for the second $1 million, on that application you have to indicate, it will be asked of you what you already have in terms of group insurance, in terms of personal policies, and you have to disclose, right? And when you do, somebody who's sitting in the head office looking at this application is going to ask this question, why do you want so much? And, does it fit with your circumstance? Right? And if it doesn't, they'll turn it down. Okay? Simple as that.
So there is a limit, but the limit is determined by your need. And you have to demonstrate a greater need to be able to get more insurance.
That's right, need. You have to justify it, yeah. And as long as you can justify it, they will write it. If it can be, you can rationalize it and justify it. This is why, people, you cannot be oversold. I mean, the best way to do it is to optimize, what you need, and, and do it as quickly as possible. And we'll see in a second, because the costs go up over time, and this is what people don't seem to realize. And it gets more difficult to get it over time. Any other questions before we go to the next part, which is the life insurance strategies? So these are really the basics. It's either pure insurance or it's insurance with a savings element. It goes up over time. You can take, it's not, there's no limit to it. You can get as much as you want. And in the next session, we'll see on how to structure it, depending on where you're at. All right? Okay? All right. So the next, it's very basic. You can either use it as what most people do. They see life insurance as a necessary expense. If there are people who are dependent on me, and I care about them, chances are, I'll see it as a necessary expense. I will take it at work, I will take it on my own, and I'll try to get as much as I can so that if I run out of time, those who are dependent on me and on my income, okay, will have something to tide them over, to see that. Now, most people see this as a necessary expense, and mostly it is set up as such. All right? And there's nothing wrong with it. It's a necessary expense, and if you structure it as a necessary expense, it's great. And because people see it as a necessary expense, they want to get the most for the least. And this is why they buy term insurance. This is why they get the most group insurance that they can get. But to me, that's short-sighted, okay? Because you can also see it as an investment. See, the glass is always half empty, half full, depending on how you want to look at it, right? So to me, the reason why I say that it's preferable to see it as an investment is because of this. First of all, when you invest something, when you invest money, before you invest, you're always asking yourself two questions. One is, what is the return on my money, right? What am I getting for my money? And second, what risk am I taking? See, I leave my money under my mattress. There is no risk. I mean, there are risks, physical risks. The house could burn down. But I'm saying there's no market risk. There's no, risk that you're subject to otherwise. But there's no return either. No one is paying me an interest on it. You follow? And then there's inflation, and then there's the money's not growing. So as an investment, life insurance, the reason why I say it's an investment perhaps the best is because we'll see in a second, and I'll give you some examples. Depending on when death occurs, right, the returns are just mind-boggling. I'll give you an example. If you die in the first year, okay, and I'm just saying, you have to be a bit, flexible in this thinking, okay? If you die in the first year, and we all are going to die, this is an event that's going to happen unless the Lord tarries, right? If you die in the first year, the return on your money, what it's costing you, and I'm using the rates of a term to 100, which is my preference, term to 100, because then it doesn't go up and throw me off down the line. It's a fixed cost for the rest of my life. And in the first year, the return is 20,000 to 30,000%. on your money if you die in the first year, okay? Across the board, whatever age you come in, 20s, 30s, 40s. That's a lot of return. I'm saying we put money in the bank. You go to, look at the banks. What do they pay you in interest? 1%, and we're talking 20 to 30,000% on return. So as a return, okay? Now, of course, this is if you die in the first year, right? Now, we don't know when we're going to die. So what I did was I ran the numbers right up till the time you die at age 100, okay? Even if you were to die at age 100, and the policies that I suggest, the term to 100, you will pay till age 100, but at the end of it, the policy is paid up. You don't have to pay it anymore, right? And let's say you were the exception, and you lived till age 100, and then you died, or even beyond, okay? The return is still 4 to 5% after tax. After tax. We talked about tax-free savings account earlier on. We said that if I go to the Royal Bank and I open a savings account, they're going to tax me on my savings unless I put it in a tax-free account, right? Now, these returns that I'm talking about, 20 to 30,000 in the first year, 4 to 5% at age 100, they are after-tax returns. And the reason for that is because death benefits are not taxable. So whether it's group insurance or an accident policy or a term policy or a whole life policy, universal life policy, whether it's $10,000 or $1 million, when I come back with a check, you are not going to be that money is not taxable. So it's tax-free. Okay? So having said that, to me, while I'm building, right? While I'm building my portfolio and trying to become financially free, in case I run out of time, I want this money. This money is going to be there, but even after I run out of time, and this is what people don't understand is, after you let's say, right up till age 50, let's say, while you're building your assets, right? It serves as to complete your assets in case you run out of time. But beyond that, in estate planning, we still need it to see, because what you've built, now the government comes along and says we want 1/2 of it. Okay? And the way we get the government out of our hair is through paying them with cheap insurance dollars. Right? So let's look at some numbers here, and then you'll get a better sense of what I'm saying. So what I've done here is, just going to open up a spreadsheet that I did, and then you'll see the various numbers and why I say that as an investment, it can be one of the best investments. Now, again, in keeping with what I'm teaching here, that in all of these things that we're doing, in the insurance, in being tax efficient, in getting rid of debt, we're never using more than 20% of your income, right? Because we still got taxes to pay, we still got our needs, we still got our wants, we've got a tithe. There's a lot of other things to do, right? So this will never take up more than 20% of your income to do. Now, let me just show you some numbers here, and then you'll get a better sense of why I'm saying this. Okay. You see on the leftmost column the age there. This is someone in his 20s, right? And the amount of insurance I'm talking about here is $1 million, and the cost is $3,033 a year. And the 1, 2, 3, 4, fifth column E, is the cumulative cost year after year, right? Rate of return in the first year, if that person who's 29 took that $1 million policy, if it dies in the first year, if you take $1 million, divide by $333, the return is 29,903%. Right? Now, if that person dies in the second year, cumulatively in column E, they would have paid $6,666. Now, if they die at the end of the second year, the return goes down to 7,451%. Still a lot compared to 1-2% that you can get by keeping your money in your own account. Do you understand? And so if we just follow through those numbers, and if we go all the way down, just to show you, till this person's age 100. So he started at age 29. Age 100, okay, the average return is still 4%. So here's what I'm saying. If I'm going to buy insurance, and if I see it as an investment, and this is what most people do, they see it as a necessary expense, and so they're trying to get the most for the least. And as I started out today in saying that time, energy, and money are finite and limited resources, right? So when I move money out, when I part with money, I'm very careful of where that money goes. If at all I can get it back, if at all it just doesn't disappear and it's gone forever, that's how I want to structure it. So in life, in certain things, you do not have a choice. When you buy food, for instance, I mean, it's consumed. You spent it and it's gone, right? Whereas if you were to structure life insurance as an expense, right, then it's gone forever. You follow? But if you structure it as an investment, if you see it as an investment, and if you structure it right, this is one of the best returns on your money. You get what I'm saying? Go ahead.
Just one quick question. With Term 100 insurance, if you actually live to be age 103 and you die at 103, does the insurance not pay you a cent?
It pays. It
still pays.
It gets paid up at age 100. That means you stop paying at age 100, and it's a paid-up policy.
Oh, they pay it out to you whether you're dead or alive?
Oh, yeah. Your question was at age 103,
yes.
Will they still pay, right?
They will have already paid at age 100.
No. At age 100, the policy is paid up in the sense that you no longer have to pay the premiums.
Right, but they still are going to pay to you.
So if you die at age 103, 3 years later,
yeah,
they will pay the policy.
Okay.
The difference in figures of 3,333 to 8,500, is that purely the difference between the 29-year-old and the 40-year-old?
Yes, we'll come to it. This spreadsheet, I ran it across various ages. So this first set that you're seeing in that color, it's for somebody in their 20s. I based it on someone at age 20, and I used current figures for this. So this is someone in their 20s. So if you look at the next set, I ran the numbers for someone in their 30s. Okay? So now you look at those numbers, instead of 333, it's 5,000. I'm going to come back in a second. We're going to do some illustration there to sort of conceptualize that for you. So one of the difficulties that I have with term insurance is that with the passage of time, it becomes more and more expensive. Hence, the topic of this session, right? Lifeboat and legacy, or expense and increasing expense. How do you want to structure this? You follow? So look, from 333 it went up to 5,000 in your 30s. Let's go to 40s. Suddenly it went up to 10,000. Let's go to the 50s. Went up to 20,000. So I'm saying that if you are in your 30s, right, 20s, it's the temptation is to want to pay, to buy a policy that is cheap, right? But then with time, 20 years later, you're going to end up paying more. You follow? And if you're in your 50s, 60s, 40,000. And if in your 70s, the same policy is going to cost you $90,000 a year. Okay? So, am I making sense here? Is it coming across? I just want to illustrate something else to you. I don't know if you've ever seen what $100,000 looks like. We're talking there $1 million, so just add 1 zero to this. Okay? Just as the cost there was $3,333, we just moved the 1 decimal point down. So $1 million, $3,333. 100,000 would cost $333. Make sense? 1 0 less, right? This is 1/10 of that. This is what it looks like. Now, there are 100 packages here, and in each package, I've got $100 bills here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? There's 100 packages here. This is $100,000. I'm hoping that this will do this for you now. When we say that in your 20s, when you are in your 20s, that it'll cost $333. If you look at absolute numbers, it doesn't mean anything. $100,000, $333, right? But let me show you what this really means. This is $100,000, right? Remember what the cost of insurance for somebody in their 20s, and I used the age 29. So if somebody was 21, it'll be much less. So this is a worst case scenario in your 20s. $333 a year, right? $100,000, $333. So I pick up one bundle, which is $1,000. I take out 3 of these, $100, $200, $300, right? So basically, when you buy life insurance, what you're telling the life insurance company is, look, okay, I'm going to give you $300 from my bank account, okay? I'm just going to move it across the street to your account. Zap my account every month, get $30 a month, and take this, and hold it in trust, okay? If I run out of time, if I don't make it home tonight, you pay my family this. Does that make sense? It makes a lot of sense. Now, ask the other question now. How long would it take you moving across your money from your bank account, from your account into your savings account at this rate to accumulate this? Okay? You're starting at age 29, so let's just round that off at age 30. Okay? 333, 1/3 of one, it'll take you 333 years. This is assuming no interest. And of course, you make money on this interest. Now that we have tax-free savings account, it can accumulate tax-free. So what I did was, just to show you what would happen, if you're not earning any interest, at 1/3 of 1%, it's going to take you 333 years to get there. If you're starting at age 30, you have to be age 363. The numbers just don't add. So there are some quantitative people who argue that, oh, but you earn interest on your money. Yes, okay, you do earn interest. So what I did was, I gave you an alternative scenario. Okay? Let me go back to the fellow in the 30s, 20s. So this is what we're looking at here, what I'm trying to illustrate there. Here's someone in his 20s, 29 years old, costing him $333 a year, about approximately $300 a month. This is for $1 million. I'm saying if you use 100,000, it's only $30 a month. Right? Okay. Now, that same person, if he says, okay, instead of doing this, right, I invest that money earning 2% after tax. If they did that, the break-even point, I worked it out, for them to accumulate the money, is age... See, by the time they I went by months here. So what you're looking at the column at the end of year 25, year 26. I wish I could go faster here, but okay, maybe I can. If they were to earn 2% after tax in a tax-free savings account, and you can't get 2% right now, but let's say you do, the break-even point would have been age 71. No, it's even more. Sorry, I don't know why that's highlighted. No, it's more. For them to accumulate the same amount of money, I think it's age 94. There you go. Age 97. You follow? So I'm saying that if this person, instead of doing this, did this to a bank and they were able to get in a tax-free savings account 2% interest, right? The break-even point is still age 97. It's only at the end of the 12th month in the 97th year that they crossed the $1 million mark. Okay? Sorry? This is based on $1 million. I'm saying this is 100. So the cost there is 3,333. So here we're locking 300 here. And just 1 0 less illustration, right? So, but the numbers will always be, so whether you do 100,000 or $1 million, it will be the same. The numbers will be the same. So then I took it one step further. Again, I deal with all different kinds of people, and you get these people who are very aggressive, and they'll say, no, we can earn much more with that money. We're going to invest it in the stock market or in more aggressive vehicles. So I took it one step further, and I said, okay, fine. Let's take another scenario where instead of earning 3%, 2%, you're earning 5%. Okay? Where the alternative investment, instead of earning 2%, is earning 5% after tax. Now, usually to earn 5% after tax in the stock market, you have to earn 10%. You have to pay taxes, then you have 5% left. Because taxes is something you have to... Even if you did that, right, your break-even point, even if you're able to do that and, stay in the market, through the highs and the lows and whatnot, right, your break-even point is still age 84. Am I getting across here? That look, you have to, use this to your advantage. I'm not, my role as the financial advisor is to I'm the intermediary. You follow? What I suggest to the people that I address is, look, use this to your advantage. What's in it for you? Let's not concern ourselves with what they do or what profits they make or not make or whatnot, right? I'm concerned with what's in it for me and how can I structure it best for my situation. This is to your advantage. So the point that I'm making is, if you see it as an expense, given that time, money, and energy are limited resources, this is another resource that you're giving up for nothing. But if you structure it as an investment, right? Okay? And this is an event that is, there's no doubt about it. It's going to happen. You will do the best for your money. Okay, structured right. So what I tell people to do is, look, given that our goal is to become financially free, and one of the ways we're going to be financially free is when we cross that threshold, when we are sitting on a portfolio of $1 million plus investment portfolio, and beyond that $10 million plus, right? This is where we're headed. But if I run out of time, I run out of health, and I cannot do this on my own, right? I want it to be self-completing. Hence the reason, if at all they buy into this concept, I tell them to take $1 million policy, a term to 100, if they can afford it, right? And if they can't, we start with term insurance, whatever you can afford, until we clear up cash flow, until we become tax efficient, and then we do this. All right? Any questions? I'm very concerned about whether the idea came across. Did it come across? Okay, good. All right. Did you have any questions on this before I move on? Because if you don't have any questions, I'd like to bring this to a close with the story of the Titanic, which I think is a very fitting and powerful metaphor for life insurance, okay? For what it does, what happened there, and what could have been avoided, and the mistakes that people are still making today. Because they choose to ignore all the signs on the wall. All right? Okay, so let me just close this, and then we'll bring up the Titanic. Now, I'm assuming everybody has heard of the Titanic or know of the Titanic. the Titanic. The reason why the Titanic makes for a very powerful metaphor for life insurance is because the Titanic was made out to be the unsinkable ship. Okay, and many of us we go about life, thinking that our lifetimes are an eternity away. But really no, it's really not an eternity away. It's a heartbeat away. And that heartbeat, can be precipitated instantly by a violent accident, in a matter of minutes by a heart attack, in a matter of days, weeks, or months by terminal illness such as cancer, right? So we really don't have a guarantee of time. And the Titanic is a good metaphor for it, because that's what the thinking was. Okay, we can bury our heads in the sand, we can take things for granted, and hope that it doesn't happen to us. Let me just get back. Okay, it doesn't. I'll pass this book around, and it's this one here. This is the picture of the Titanic itself, and the Titanic had the makers of the Titanic. They made 3 mistakes in design. The reason why the Titanic went down is because there were 3 mistakes. Okay, that occurred. One is that during the time that the Titanic was made in the early 1900s, the Industrial Revolution was at its full blast, and shipbuilding was, all over the world, people were building ships, and steel became very much in demand, and so while they had this project going, there was a shortage of steel. And so they compromised on the quality of steel for the rivets. So because they wanted to come under the deadline, they used the B quality steel to build the boat. This is why when you watch the movie The Titanic, when it hit the cold waters, you see the plates popping out. It's because of the B quality steel. And the only reason they used the B quality steel, not the money was an issue, the supply wasn't there. And they had to compromise on some things. For the rivets, they used the B quality steel. Second thing is, on the Titanic, they only had 20 lifeboats. The design called for 64 lifeboats, but when the owners of the Titanic saw the completion, they asked for the lifeboats to be removed from the promenade deck because they didn't like, the optics of what they saw. So they brought it down to 64 lifeboats. There were about 2,300 passengers, and there was only 20 lifeboats which could only take about 800 passengers. And hence, second mistake that they made. The third mistake that they made was they got so arrogant and cocky that in the crow's nest, they didn't even have a binoculars. Okay? They spent so much money, their priorities were all misplaced, right? They neglected the smaller things. The reason why it serves as a good metaphor for life, we tend to do the same thing too. Okay? We cut corners, we compromise, especially when you're seeing it as an expense. You missed all of this. You follow? And you're hoping that the worst does not happen to you, but it could. Okay? And hence the reason why when we set up your plan, we as far as the quality, we make sure that the companies that we are dealing with are financially sound, and we make sure that it's designed in a way so that when your financial ship hits an iceberg or a storm, okay, or icy waters, that it doesn't buckle and go under. Right? I thank you very much for your time, and we are going to do. I'm going to bring this to a close, and beyond this, we're going to do a survey. And I thank you for being here.
प्रभु जी ऐसी धूम मचायो सकल जगत को, उसने बचायो उसकी महिमा करूं मैं अब